Hello, everybody, and welcome to Hedgeye NexGen, where we are going to continue to help break down finance into its simplest form and help you build wealth. I guess we have an intro, I think, which really means we've made it, people. And it has EDM music. I don't know how Marina knew that I loved EDM music, so thank you to the team for that. Okay, so on today's episode, we have our first ever guest as well. We have RPK joining us. He is a portfolio manager at Hedgeye Asset Management. Hello, RPK.
Hey, I feel honored I get to be on this show. This is real. I've watched a couple of episodes. I'm like, long-time fan, first-time guest. Good.
And you get the first ever guest, first-time guest, and the first one with a real
With the
intro.
intro, they picked it for me. Actually, I was gonna say I kind of share your EDM thing when I listen to. I love like EDM kind of low-key EDM music for when I need to focus on something. Just kind of play it in the background if I'm like focused on like a task. I'm trying to like work on a spreadsheet or try to do that. Like just having that going. It's like little pulse, little keep
Yeah,
it.
what do they call it? Isn't it like high? Well, funny enough on that, I don't know if you've looked at your Spotify Wrap, but the new thing this year was they put an age on what your age is for as a Spotify listener.
Yeah.
My age is 85.
Which you're playing a lot of like the take the A train from the 1940s or something.
So what happens is I don't listen to the EDM when I'm working. I listen to jazz. So it's all like 1950s jazz type things while I'm working. So I have like
Things I'm learning about Ryan. This is awesome.
Yeah.
I like it, man. I love jazz. Yeah.
90,000 minutes of jazz, and so that makes me an 85-year-old allegedly.
Is this so? Are you more the like the golden like the swing era, or are you like the sort of bebop cool jazz era, or are you more experimental Weather Report 1970s
West Montgomery. So
okay.
that, or songs like Moanin', and really anything with the saxophone. I played the saxophone, so I played
nice.
the Barry.
Wait, so you must listen to Wayne Shorter. I mean, all that stuff's amazing.
I'll add that to the list.
Wayne Shorter is like my go-to Sunday morning making coffee music. You know what I mean? Like
Really?
having a coffee, reading news, go put Wayne Shorter on. It's good stuff. This is the important
Oh,
details
yes.
people came to this site for.
No, actually, yes, I have. Yeah. I honestly, it's basically this massive playlist of like 20 of the best or most famous jazz, and I just listen to it on repeat. So
Nice.
anyway, so guys, we'll get back into this here. So what we're going to do here is we're just going to get to know who RPK is, how you think about portfolio management, what is portfolio management, and also get into what we feel like is the evolution of active management and how you think AI is influencing all of that. And then also, guys, if you have any questions, send them on into the chat, and we will ask them in real time. And so I guess my first question is, what is the real version of your background that matters for how you invest?
I like this. All right, so let me think about how to frame this. I mean, I'll start here. I went to Bowdoin College, go you Bears, and was in English and philosophy major. And I also did some pre-med and took economics 101. And that was about it. Maybe 102. I can't even remember if I took 102 at that time. So when I graduated from college, I knew the Dow Jones meant something to somebody, but I didn't really spend a lot of time thinking about it. What I did get into though in college and then much more even after college, I just really got into following current events, following news, and I started off. I got a job. I was playing in a band, actually, and I needed a day job, obviously, so because that band wasn't paying for my life, so I found a job working for a freelance writer. He had this company called the Writing Company, which was effectively did a lot of copyright stuff for for large investment firms, but also he used to write like the Wall Street column for Money Magazine or something, like one of those types of things. And he had gone freelance and had this like sort of little company where he had a couple of people helping out. And I can't, so he hired me to basically come in and do like, fact checking, editing, sometimes he'd have you help research a piece he was writing or something. And at the time I was like, okay, I don't even know what these words are. Like EBITDA is that a word? What is this? And so he sort of like started to say like, all right, well, like I can't teach you all this. So here's some books if you're curious. Like this will help you once you read through some of this. And he always kept the Wall Street Journal around like in the office space that he had. Um, and so I just like started following this and I found it fascinating. And I was like, wow, like how did I never get into this before? So when I started to, within sort of 6 to 12 months of graduating from college, I just pivoted to try to find a job doing something more closer to Wall Street. And as you can imagine, a English and philosophy major from a liberal arts school is in high demand on Wall Street. So I didn't originally, like I ended up working on the sell side at first. And then quickly was like, all right, well, how do I get to be, like an analyst or something? So I started doing my CMT, or sorry, my CFA, and then my CMT eventually. But I had, yeah, when I was doing informational interviews or on the buy side, trying to get to know people, to network, and eventually a woman hired me to be a research associate at Schroders. And so she was a portfolio manager in small mid cap funds, and then just serendipity, she was very kind to me. Like she was mentoring me. And then we had our healthcare analyst quit like probably a year or so after I was there as the research associate. And she was like, well, it'll take me longer to hire an analyst. So why don't we just make you the healthcare analyst and we'll just we'll get another research associate. So it was a little bit of a, crash course. Like I basically didn't expect to be like, already selecting stocks for a portfolio within a few years of having started. But then, that's kind of where it got started. I was a healthcare analyst for her for several years, and then someone reached out to me from what was then the Boston company. Now it's BNY Mellon, but they had looking for healthcare analysts and had heard my name from some people, and then I ended up going over to there, and then I picked up doing like transports, and I did some energy and some other stuff while I was working on this much larger opportunistic book at BNY Mellon. So then, it's kind of been the story. I mean, I did that. I went to hedge fund world for a few years, and then had ended up at Wellington Management for a while. And and I've known Keith for probably going on 15, 16 years since when he started the business, and I've been a client the whole time. So I know we can delve into any parts of that. We can click down into any of what I just did a flyby on.
English and philosophy, that was not on my bingo card today. What?
You'd think I'd actually be more eloquent and write better, considering those were my majors, but alas, it's rusty.
I failed all my English classes. It did not go well for me. They didn't like how I wrote. Apparently, it was not by the book.
Imagine how you do now. You train an LLM to write for you. You'll be fine. Yeah.
Exactly. Yeah, I'll do it for us. What instrument did you play in the band?
So it was my first lesson in supply and demand. When I was in high school, I played guitar. When I first started high school, I got a guitar in junior high school, and then I started playing as a guitar player my freshman year, and quickly realized that there were a lot of people who played guitar in my high school, but nobody played bass. And there's like one guy who played bass, and he graduated, and then there were no bass players, and I was like, I think I'm gonna switch to bass because then I'll be in everybody's band. So I play guitar, but I'm primarily a bass player. I've been a bass player for a long time. And so I play in a band now. I have a cover band now.
Oh, really?
Yeah. I keep teasing Keith that I'm like, at some point I'm gonna have this band at a Hedgeye live event or something.
I'm here for it. I mean, I think that's what the people really want to see is you in a band on the bass.
Yeah, exactly, right? Exactly.
And we'll get all the Hedgeye folks. Everybody will be on the dance floor.
We'll take Hedgeye process Q&A from the stage. It'll be great. Yeah.
Oh, That's really cool though, because I mean, really it just sounds like it was a very long grind for you from the very beginning, right? Because it's really a career pivot that you made.
Yeah, but it's sort of funny, right? Like I talk about this a lot with when people have asked like, oh, I'm really interested in investments. I'd love to like be, in like work in that in what you do. And I'm always like, that's fine if you know like if you know that's what the work if you know what the work's about and you know that it's gonna suit you. I think like a lot of times people, have a tendency to focus on careers like as a noun, not a verb. Like they're sort of like, I want to be a marine biologist. I'm like, do you know what marine biology looks like? Like, like you're going to be at a like mostly like in a lab. You're not going to just be like on the beach. Like you're going to, So I feel like there's it's a similar kind of fashion to me of like I didn't really ever know where I would end up. I just kind of knew once I got started. I just kind of went toward things that I found interesting
Yeah.
and that intrigued me and that I liked doing. And then every time I did that, if there was parts of it I didn't like, I'd try to find a job where I had more of what I liked and less of what I did, and then sort of eventually, you kind of find your place, right? You kind of end up where you want to be.
Yeah. No, that's really cool. It's really cool. Yeah. So it's all about you're just almost sounds like you're seeking for what ultimately would fulfill you, right? And it ended up. I guess you ended up here for
Yeah, I
now.
mean it's kind of yeah, it's wild. I mean, I wrote this in the early look a couple of weeks ago when I had stepped in to write one was that I had even told Keith like years ago that I was like I'll bet we'll end up working together at some point. Because I mean he when I first met him and I first saw some of the research from the nascent Hedgeye firm at the time, it just was it resonated with how I think as an investor. I mean, this is I'm always sort of looking for what's happening at the margin,
Yeah.
what's the rate of change, what's the rate of change on the rate of change. Like that to me, I quickly figured, like observed early on when I had a career. Because I mean, when I took over being like the healthcare analyst, right, I had no idea what I was doing. Like I had been a research associate for literally a year.
Yeah.
And she's like, why don't you just take on healthcare? It's that's a real simple space that you really understand everything. Right? You don't have to like, so there were like, lots of terms and concepts. You're like, I have no idea what this is. But you sort of just dive in, start learning the subject and getting into it and asking lots of questions, and that's usually gets you where you need to be. And so, but I quickly observed like that it did. So it's like it's not like the static that matters. It's what's happening at the margin that matters more than anything else, right? Especially, and that's probably only gotten more true through my career because things move so much faster.
Yeah.
I mean, just think about the pace of investing and how it's gone on over like 100 years, right? Like literally, you would have been getting 100 years ago, you would have been getting your quotes off like a printout ticker tape that was like coming out as each
Yeah.
trade went off. Like it was like coming off a printer and you could see like, ooh, 100 shares of this Coca-Cola company just traded hands. Like, I bet that's an up and comer. So there's like you think about how much that's like now where we have like all of this on your screen, like immediately, anyone who's using Bloomberg or Facts or everything, you got all this stuff, like every piece of information that's happening instantaneously all the time. And that's that before you add quant and then AI quant and like all the other things that are going to be part of what we always call the machine
Yeah.
around Hedgeye.
I keep trying to find the best data for it, but it's almost I think the numbers it's at 85% of daily trading volumes done by algorithms at this point, and only keeps going up.
I mean, you can pick a number, I would believe it. Yeah, I mean, like it's
Exactly.
Like,
It's really funny because you say that, right? They used to have sheets, or it was just phone calls, right? And then I was just looking at what I was doing last night. I got an entire options chain on the 1 minute tick basis. So let's call it. It was 10 million rows. And I'm doing analysis on 10 million rows of over 7,000 different options with a computer within 30 minutes.
yeah, I mean, think about my first job, it was 25 years ago. So like I was in like 2000, right? So
Yeah.
like I was sitting there, like when I started the job at Schroders, like we were getting daily research faxes from Goldman Sachs or from all these places. Like the salespeople would like fax us these reports, and like there was in the mailroom, they were just like falling off the fax machine in the morning. It was like, oh, Bernstein's new energy report. Like you were putting it together and stapling it and going out to read it. And so like it was in that year that it was like, oh, they emailed me the report. Wow, I can just open it and read it right on the screen. Like, people were still printing it, just slaughtering trees. I was printing everything.
Oh my God.
Yeah. Because everyone was so used to just reading. I mean, they were also used to like everybody's offices back then. I feel like in the investment world were like piles of paper, like 10Ks and everything, like the highlighters out on them, and like those.
Time definitely change.
Yeah.
Here's a question. So you started with healthcare, right? So what would be your style of investing that you started with, and what did you have to unlearn from what you started from?
That's a great question. So I would call myself an opportunistic investor. All right. And the reason I worked on funds that are called opportunistic. I worked long short. So I got really comfortable with the idea that like sometimes value stocks are expensive, sometimes growth stocks are cheap, right? And I've done a lot of stuff over the years. I haven't updated this work in many years, but I think it probably still holds true. I know from looking at some of the factor trends in the market, like what groups of stuff has worked, that this probably is still true, which is that I had done like a project on what the value of perfect information is. So if you had a crystal ball, what would that actually return for you, right? Like, and so how I framed that was, all right, if we looked at a strategy that went long all the companies revising earnings and short the ones that were missing earnings, like revising them lower, how does that portfolio do? And if you do it on sort of ex post, like you already have the information, like that was actually a strong factor for a long time. You could actually literally just run that program for years, but then it kind of faded away because so many people started running that, got arbed away, and it really doesn't work that much anymore, just buying earnings revisions straight up. But the where I thought it was interesting is when you take that basket and just rolled back like 3 to 6 months prior. So take the top revisions, right? It's what if I knew exactly the companies that were going to revise higher? That annualized at like well over 100% return. Yeah, it's wild. Like, yeah, I mean, with no risk because it was basically a long short portfolio. And so all like it led me to thinking about like, all right, so the whole key is having like an idea, like your quote edge. A lot of people would use that term, and that's, I think popular culture has made it sound like that's some kind of a nefarious thing, but all it is really like, do I have a differentiated view of what the earnings trajectory for this company could be versus what I think most people think, right? What's my aberrant view of what's going to happen, and that's actually what ultimately is the excess return that you're getting paid to find. And then it's everybody having a different ways of approaching how they find that. And early on, I started working when I worked at Schroders, those were ostensibly value funds. I worked on like a small cap and a mid cap value fund, which was an interesting time to work there. It was in 2000 because we were right at the peak of like the dot-com bubble in like 99, 2000. So I worked with this value fund where they were all kind of like ready to jump out the window. I guess it had been so bad. And I come in like, why is everybody feeling so terrible? And then like within 6 months, it's like everything was like, had totally changed. And the value ripped after that, and like the dot-com stuff imploded. But what I learned over time is that there wasn't like value is a tough place to play sometimes in healthcare. It used to be. And like honestly, the best stocks in healthcare are often growthier stocks. And so it's been I think that to go back to your question about like what you have to learn and then unlearn along the way, it's like I was sort of mentored originally as a value investor, but quickly figured out I liked growth stocks too. So it was like this sort of weird thing where I just kind of fashioned myself more of an opportunistic because I'm like, I don't really care whether it's value or growth. I just want to know that I can develop some kind of differentiated aberrant view from what consensus is and have a reason why, and on balance, if you're right more often than you're wrong, then you're gonna outperform.
Interesting. So it also sounded like what you were doing was you found like with that other strategy you were talking about, right? you're making money on what was happening, which was the earning revisions, right? And then your opportunistic view was that worked. Now we have to front run that in terms of what will happen, and it's almost finding an opportunity there as well.
Yeah, so it's one of my favorite investment books isn't really an investment book. It's Theory of Poker. And it's because there's a couple of key concepts in there that even though I don't like to necessarily use gambling as analogy for investing, but they do share some similar things. And one of the key ideas in the Theory of Poker is like pot odds, right? Like what am I playing for, and does it make statistical sense? And like, is the upside enough to justify staying in based on the probability of this hand?
Yeah.
And so that to me is like big definition of what I'm like trying to look for when I find ideas, right? Like I had an investor I worked with years ago, it was like a hedge fund, and he was kind of a tough guy to work for, but he had a lot of funny like things that would come out around that. And someone said, started to make a pitch to him, where he's just like, well, I think the earnings are here, and then they put the multiple for. He's like, let me stop you. You're gonna roll the multiple for. You got 20% upside to your price target. He's like, that's every stock in the market somebody owns, thinking they're gonna make 20% on their earnings. And I was like, I should have done like that. I was like, yeah, you're kind of right. It's like if you wanna catch the like positive earnings revision, well, you better have a case where it could really blow the numbers out, right? Like if you're just like playing for like, well, I think margins are going to be this much better and therefore they're going to beat. It's like, that's tough to do consistently. It's certainly tough to do consistently for a like sort of generalist portfolio manager or someone who's doing multiple sectors. Now we have incredible sector specialists at Hedgeye who doing incredible work to try to find very small discrepancies and things. But I always looked at it like, from my perspective, I need to know that the pot odds I'm playing for are really potentially huge, so that if you catch those revisions, you can get really paid for them.
Yeah. And then just for our audience, everybody, so value investing, just to break this down a little bit, value is very much, think of, right, Ben Graham, right? It's your companies that are kind of beat up a little bit, but they're going to start re-accelerating into the future. Maybe they don't have a lot of growth right now, but they're beat up a little bit, but they're going to make some change, right? The growth stocks are your Nvidias, the things those big names, right? Growing 100%, right? That's what your growth investing is. And then in terms of, you were just talking about kind of like DCFs in a way, but right, you were talking about everybody has a 20% upside. So just so everybody knows, in the fundamental analyst role, what a lot of these people do is they have this spreadsheet, and their whole job is project out what revenue is, project out what their expenses are. And like the funny thing is every single time they go through all that, you eventually go to what is the value of what the stock price could be, and every single time you'll come out between 20 to 25% upside in terms of that. So that's what he was talking about. So that's what most of if you hear your fundamental analysts, their job is to make these things, to project out revenues, costs, and they're called DCFs.
Yeah, it's funny. My background. So the one thing that's funny about coming from a little bit of an unorthodox background for finance, right? Doing like English, philosophy, and then some science, because I was doing a lot of undergrad. And the modeling stuff always cracked me up, like because there's like people spend a lot of time building very detailed models, and then coming to very specific like forecasts and conclusions. And the little bit of scientist in me that did like pre-med stuff is like, that you can't do that. if you're making these assumptions in the model that don't even have like a decimal place, you can't get a 2 decimal place answer. Like, that's crazy. Like, that's just the rule of significant figures. You cannot do that. So it's like, you better have like if you come up with a point estimate, like, man, no, you really should be coming up with a range. Like the idea that I'm gonna like pick out all these assumptions and then come to a point estimate is like just crazy. There's a lot of crazy things that people do in finance that don't make a lot of sense to me, but like that is definitely one of them.
It,
The odds that you're going to land is stick the landing on the actual forecast. It's like, okay, don't you just need to get it directionally correct? That's what matters more.
yeah, and yet that's what the whole industry is almost still based. Well, it's changing for sure, but that's what it's been based off of for a very long time. Are those single point estimates? I have another question here. What were your biggest early influences? It could be a person, a book, a market era.
I mean, one of my biggest influences is a funny story I told actually, I think on one of the other interviews I did around like with I think with Keith when we did the Hedgeye Investment Summit. But it is like one of the most fundamental things that I learned just with serendipity. I happened to go to my first healthcare conference as like this newly anointed healthcare analyst who had absolutely no business in that job. And I head off to my very first healthcare conference. And at these conferences, right, there'll be like lots of companies presenting. In some cases, people get, if you're, a big enough investor and you can, or maybe you're a big shareholder in the company, you can get a private meeting with them, but with the company. But mostly you just like kind of go to these presentations where company do updates on their fundamentals and they talk about the business and all that kind of thing. And they'll host lots of, and the investment banks host lots of different ones that for different sectors, and sometimes they'll do ones that are just generalists. But like I used to go to so my first healthcare conference I went to was this like Goldman Sachs ran this healthcare conference, and so I go out, I'm like, and I show up to my first meeting and I'm like literally like looking around me like, what is everyone else writing down? Is this all stuff I'm supposed to have known, or is this like is this all new information, or is this and I'm watching the woman sitting next to me is like jotting down just like a few phrases and things in these like boxes she had arranged on like the paper. She had like her own worksheets she had like printed out that had like, revenue, margins, TAM, like balance sheet, cash flow statement, kind of like, and so every time they would say things, she was like mapping it to that for her notes. And which of course, this is the first conference I'm at. I'm like, maybe this is what people do. I mean, maybe I'm supposed to, what I wasn't told I was supposed to get the worksheets. I'm like, I had no idea. So we were getting up to leave this first meeting. I started talking to her and I'm like, oh, I'm sorry, I hate to bother you, but like, just curious, I saw you were doing, is that something you made or, but she's like, oh yeah, I made these. She's like, it's easy for me to go through my notes and track where each thing by category, like where I looked at it. So that's interesting. I just started a job and I'm trying to focus on figuring out how to do this. And she turns out in hindsight, I didn't realize at the time, she was like some really big time, like healthcare, like hedge fund PM who at like a very respected firm. I just had no idea who she was. So I'm just like talking to her randomly.
Yeah.
And she just turned to me as she's leaving. She's like, well, I'll tell you what, here's the thing. Focus on the change, right? And it's the good analysis is the rate of change, and good portfolio management is the rate of change on the rate of change. And then she kind of just walked off. And I was like, oh, whoa. And I had to like think about that. I was like, I'm like, now I got to understand what you meant by that. And yeah, that's I think that's probably one of my most formative investment, experiences. Because after that, it really shaped how I started to think about the information I was getting and what I wanted to do with it.
Yeah. So it sounds like you're almost. Do you find yourself that's really all you look for now is where is the change in these companies?
And getting a feel for how they like, I've looked at a lot of companies, modeled a lot of companies over the years. There's nothing wrong with modeling companies. I actually love modeling companies because it just gives you into the sense of like what the company is and how the parts move and like what the model is. Like that helps you just sort of understand it. It's not about forecasting the numbers correctly. To me, it's more just it's about understanding what they do and what the model looks like and like how they make money. And then what the sensitivities are. Because that's the thing that when you hear that new piece of information, you're like, oh, corn prices are up 20%. Dude, that's like 40% of their costs. Like numbers are going down. Like you gotta you gotta be able to process it and move like very quickly on stuff that you hear, right? Like you hear a company, says like, oh, we're gonna cut capacity. And like you quickly want to be like, oh, geez, I mean, how many they have like 200 manufacturing facilities. If they got 50% of them, you could get this much out. It would drive earnings up by X. Like you got to quickly get to those things and like figure them out fast, and figure out the magnitude. And it's not about getting the numbers right. Like, well, my second quarter earnings are going to be 3 pennies higher because they're cutting the capacity. It's like, no, just get to the earnings power. Like, what does it actually mean when they do this? And where would numbers be then having to be revised to over multiple quarters? And trust me, if you get ahead of that, you're gonna find a good stock.
Yeah, it only sounds like what you've, I guess, built in terms of how you think is you find where follow the money. You're following the money, and by following the money, you understand what impacts which companies and how much it impacts the different companies, and now ultimately lead you towards those changes in terms of what they will say in terms of revisions.
Yeah, because the three biggest things on the market, like think about like over the last, it's been 10 years, I think it's longer than this, but I mean, I can look at it, literally looked at it on Bloomberg like this morning. You can see that the things that have been the most powerful over 3, 5, 10, 15 years in the market have generally been like getting like multiple period earnings revisions right is a huge, like, so if you find companies that are revising earnings for multiple quarters, that's been one of the top performing factors in the market. Alongside sort of momentum and growth. And those are all kind of, if you think about it, those are all kind of related, right?
Yeah.
They may be parsed out as like different factors, but they are all kind of very weirdly interrelated with each other because a company that's growing and has momentum is probably both of those things because that growth is translating to numbers having to be revised higher faster than people thought they would.
Yeah, very interesting.
I mean, some of the best companies in the world, if you had known what the numbers were going to be, like not like, hey, well, we were projecting $3 of earnings in 3 years. It seemed like an expensive stock. But that turns out then 5 years later, you look back, you're like, you know, that $3 actually ended up being $7. Like,
Yeah.
then you go back and look and say, oh, the company was actually cheap if we had known what the stock was like. That's where you sort of break down this, like value investors tend to want to focus on things that are currently look inexpensive today, or at least that's the classic version but you're like, if you're willing to just kind of go out a little further and be like, and understand the company and well enough to sort of make an earnings projection that you could be like, well, hold on, they're projecting $3 earnings, it could be 10. Like all of a sudden that's a very big, like, I mean, that's actually it's funny, it's like one of my best choice stock picks of all time was I was at another healthcare conference, and I wandered I used to love to go fishing in like broken IPOs, like things that had come out, and then they punked their first quarter or something out of the gate. It did, like, sold off, and now everyone's just kind of like walked away from it, and it takes like 6 to 9 months before anyone wants to do work on it again.
Yeah.
And I went into this meeting at like to just see like I wandered into like it was like an empty meeting. These guys were in there, broken IPO. The guys are presenting to an empty room. There's like 4 people in the room, like including me. And it was Intuitive Surgical. And they were like, yeah, we've got these like surgical robots. and I'm sitting there listening, and I'm like, and you know, they were losing money or whatever at the time because it was still an early stage startup, and it was an IPO that had just come out like 6 months ago. Stock was down. And you know, they start walking through the model, like we're probably likely going to get our first approval on this thing in the coming months. And then I'm like the only person there, so I'm just asking questions. So I'm like asking, well, how many of these, you know, could you do? How many units can you sell? Like we start walking through the model, and it's like I leave the place, and I'm like, well, man, if everything goes right, the stock's trading like 15, and they could earn like $1.50 in like 2 years. It's like, and it's robots. Like it's gonna get a better than 10 multiple. This is robot surgery. It's gonna get a good multiple. And like that, I mean, that stock went insane after that, right? Like it's amazing to me that like look back and I'm like, that room was empty. Like that's wild. Like, and if people think that stuff doesn't exist, like that was, you know, that was 20 years ago or whatever. And so, all right, maybe that you feel like that doesn't really exist anymore. I'll tell you, just 10 years ago, I went to a conference and NVIDIA couldn't fill a day of meetings.
Wow.
Like no one wanted to talk to them.
Wow.
They're like, oh, they're a gaming company. They keep telling this story about like hyperscalers, but yeah, that's this that guy's super promotional, you know, like literally. I mean, that was the 10 years later, it's like one of the best performing stocks ever.
It really changes quickly. I actually remember I had my first introduction to finance was healthcare. So in our high school or college, it was the healthcare PM. So
oh wow.
Yes. So Intuitive Surgical, I know them very well. But that was probably back 2019 or so. So you were probably a little bit before that.
Yeah, still been a good stock even from then. So like it's been an unreal ride.
How does a trade become a position for you?
Oh, that's an interesting question.
And what does it have to pass to become that position?
Yeah, I mean, so I tend to look at it as like what I call change elements, which are just like that thing at the margin. Like what's in the thesis? Like what's at the margin, the thing that's going to drive the revision, earning upcycle, that kind of thing. Um, that's kind of looking usually for that. And then I have my own, like I have what I call my intrinsic value model. I mean, it's sort of a DCF, but it's one that I've structured to put guardrails around so you can't just torture it to tell you what you want to like find out. There are hard stops. I'm like, no, we don't put numbers that big in this thing because that's historically not accurate. You know what I mean? Like, so I try to just keep it boxed to things that are realistic, so I can get a rough idea with companies, like what I think it should be worth, right?
Yeah.
Not that my opinion of its valuation isn't going to ultimately matter that much, but you do want to at least have some frame up of like, can I justify why this would make a much better return, right? Like,
Yeah.
and so. And that translates for me to like a competitive rate of return embedded in the model. Like I don't like again, the reason I hate point estimates, like we talked about this, because we also get then price targets, and price targets are like a static thing that people then update every once in a while when they've got new information, and then they like kind of just like roll them forward with the calendar. But like I mean this like. But theoretically, they should be just like compounding continuously, right? If something's like compounding through the year, like your price target should theoretically be just moving up every day in line with the cost of capital, and so or the rate of return you're earning on this investment. So I was kind of like I always really hated price targets because it had a tendency to create like selling your winners, buying your losers kind of mentality, which does not work. Like watering the weeds will not get you a very very good looking garden. So that's kind of a key input. But then the most important one on top of that is like the reason we're here working at Hedgeye Asset Management is because over the years I became even more I think aligned with thinking of using signals to understand like risk management, understand when things are in your favor and when the odds are in your favor on investment. And to answer your question, like all investments, almost every position starts as an investment. Some of them become trades. Some of the trades turn into long-term investments, if that makes sense.
Yeah.
Like, right, you kind of always go in with like an idea like, well, I've got an event path that's going to play out over a certain amount of time. So by definition, I'm investing through that period of time. But then at the same time, like the value of information decays over time. So like you're constantly going to be revising this and changing it and making sure you have some kind of way to adjust your thinking and watch for things you don't know that might impact the investment is kind of important. And so that's where like I think technicals were the first place I went. Like I did my CMT and was the technician, and I used that for risk management, sometimes for looking for new ideas or screening for new ideas. But even then, I always found it was some of the ways they do that are a little too simplistic, which is a little bit why Keith, resonated a lot with me, right? Because we got into, really using almost like the fractal math and better understandings of how markets truly function across like price, volume, volatility, right? The things that we can see, and that most practitioners are running like with underlying assumptions that don't accurately depict how the market truly functions, which is an opportunity. That's why the risk management process adds value. Like, I mean, ultimately.
Yeah. So it really sounds like for you, a trade it's all continuous. You don't know where it's going to end up.
Yeah. I mean, when I started off as a small cap investor, there was actually a paper I remember reading that was like, small caps had a tendency to like, almost all their outperformance came in a very short period of time. So even if you bought the stock, held it, it might just be like, it did okay, and then it had like a big move up, right? And now you have to decide, like, am I going to hang with this thing, or because it just outperformed by a ton? So it's like, it's probably not going to do that again, like unless something's now changing even faster, like if the rate of acceleration is going up. So now it becomes, you're holding this if you just got paid for it, or are you like, and you know, sometimes the answer is yes, because you're like, wow, actually that news event it changes my whole way of thinking about it. I think it's worth a lot more, like whatever. I mean, it tends, and then you'll be willing to let it trend.
Yeah.
But, you know, sometimes it's just, that's the end. You're like, all right, well, we got paid on what we saw. That was like, we thought this was, you know, that's what could happen, and it happened.
Yeah.
Yeah.
Very, very interesting. I'm learning a lot about you, RPK.
That's what you said this was about, right? So.
That's what we're trying to accomplish here. I want to kind of pivot a little bit into the evolution of active management.
Yeah.
And maybe I'll start off with asking, what are the biggest structural changes you've seen throughout your career? We can take this anywhere you want to go.
I mean, like, yeah, I mean, you can see how the speed of technology has changed things a lot, right? We talked about this up top, like a little bit about the, like, you think about just where it used to be like maybe a ticker tape, and then it was like, you know, a Quotron machine that you had in the office where people would like go over and punch up the ticker that they wanted to see a price on. And then those became Bloomberg machines, and everybody shared one Bloomberg. You didn't have it on your desktop, or like they were all sharing it. Used to, you know, books filled with the financial statements from like Value Line and stuff that people kept in libraries in their investment offices. And so all of that stuff is disappeared. I mean, it was already on its way out when I even got into the business, but it was still around. There were people who worked, and that's the way that was their process and the way they worked. So it was like it had to stick around for a while longer. And so, like, the speed at which things have changed now. I mean, once we were like moving into Blackberries and then smartphones, like that you were able to even get your email and having stuff sent to you all the time, and you could read off like at night, or like you would be getting research now from people on these devices. And so I think that whole element of it has just sped things up a lot. And then the composition of the market's changed so much. I wrote about this in the early look a couple of weeks ago. It's just that, like, when I started off like 25 years ago, there were like half the money, maybe even slightly more than half of the money was, the majority of money was actively managed, and of the actively managed, more than almost half of it, and if not slightly more than half, was value. Tend to focus on like value investing. That's now, like, active is now less than 50% of total, right? If you look at, when you think of just like quant and passive taking up the rest of it, and of that less than half, like, and even 25% of that is value investors. So you're down to like a very small percentage of people who are actually really even paid to care what something trades at, right? In this place, you've had what we were talking about over the earlier. I said, like, the top performing factors over the last 15 years have been momentum and growth and earnings revisions, and some of those could maybe come from value, but they really come from also from growth, where there's more growth to drive earnings revisions. So it's that whole composition's changed now, because there's so many. The majority of this is now all run more as a momentum chasers, and as well as and growth investors who've become a huge part of this, but then also just passive, which is just literally kind of market cap weighted systematic strategy. Yeah, I mean, that's a big change. And you could see it. You could see it over the years, because it just became harder to understand, like, things that used to bottom at a valuation just would go right through it and get cheaper and cheaper and cheaper if their, like, earnings were bad, right? And people would be like, oh, these guys, things always used to bottom at one-time sales, and like, yeah, it doesn't matter anymore. Like, it'll go down until, like, the earnings stop going down, and then it'll go up when they start going up again. And it won't matter really what multiple you were paying at either part of that.
Yeah. And you find that people are still operating in that old way, or is it almost?
There are still a lot of people operating that way. Yeah. I mean, I think it's less. I mean, there's a lot fewer people doing it, but I think the people who have adapted and changed their strategies a bit, I would say, like, my investment process has changed a lot over the years, because it's like, it started off, much more of that kind of like value focus, because that's what I was told I was supposed to be working on. But then I kind of like gravitated to finding more interesting stuff in the growth space. And so then I tried to almost like harmonize the two in my mind, right? That's why the intrinsic value model is supposed to be kind of like, I can kind of value anything. Like, I'm like, I don't care if it's growth, I don't care if it's value. Like, it's like, if you're playing basketball, you're like, well, I'm only a left-hand dribbler. I'm not a right
Yeah.
dribbler. You're like, it's just like, I mean, stocks go up because there's a misunderstood expectations gap. And that can be because the valuation was too low or because the growth was less than anticipated, right? So like I don't feel like it matters one way or the other.
Yeah, and I feel like, well, the big thing everybody says with active management is you can't outperform the market. Like, have you found that alpha is harder to find, or is it just harder to keep?
That's a good question. I mean, sometimes I think it's gotten harder to find people who are like just sticking to the way they used to do things like 15, 20 years ago. I think that's made it very hard to play those games. Um, Buy and hold, valuation focused, like it can work. And I had a pretty good run like for several years there when like interest rates were on their way to like 2, and so like you just kept putting multiples up on like quality businesses, so everybody could be like a quality growth manager, and literally the discount rate would just go down every year and their portfolio would go up in value. So I think there's that. I think that's part like an element. I think people who've adapted are actually, it's a great time to thrive for active management because nobody thinks it works, which is actually kind of like, well, it obviously clearly does. We have plenty of hedge funds and things that have done quite well doing this, right? So I think it just becomes a question of like how does it evolve, kind of to the
Yeah.
original point of your topic, or like how well are you risk managing? How much have you sort of adapted what you think is philosophically fundamentally true to the current environment and how the market's structured, and are you playing the right game when you're sort of approaching and engaging it?
Yeah.
I don't know. I mean, I'm doing all the talking. I should kick it back to you. What do you think?
Um,
Or you kind of came into the market in the last few years. Like, how long have you been working there?
2021. I think August 2021. Whatever that date is. It's on
Okay,
my whiteboard.
right
Uh,
on. Did you work from home just for the first like while
no,
or no?
no. I
No.
think I think we're back in the office. I think this was one of the few
That's yeah,
firms.
21. I guess that's true. Yeah. No, we took a while at my Mellon. We were like still at home for a while. But,
Yeah,
okay.
yeah. I mean, I think for me, well, I approach things a lot differently than what I even thought about in school, right? In school, we used to make fun of our macro people. Like they would just be pitching us ETFs and be like, what are you doing? What's an ETF? And we'd literally make fun of them. To now I'm literally working as a macro analyst. I guess I'm laughing at myself at this point. And all I do is ETFs. But I really feel like, because, and again, I was classically trained. Here's your Excel spreadsheet. Go do it. What's in the Excel
Yep.
spreadsheet? And I just think it has changed so much from that, and that like the future is going to be a lot different, and it already is getting different because the amount that you can scale is unbelievable when you park that Excel spreadsheet somewhere else and you go into
Yeah.
different types of momentum, quant analysis. Again, well, the way I started, right? I downloaded 1 minute ticks just for the last year, and I have over 10 million rows. That crashed my computer trying to run and get all that. But now I put it over into the cloud. I have all that. So somebody with an Excel spreadsheet can't even open it, know what to do with all that data, right?
Right.
Like,
Right. Right.
so it's going to continue to change. It's going to continue to change quickly because, I mean, again, another way is like I brought tried to bring AI trading over to Hedgeye, and that was back in 2022. They were like, "What is AI? What do you mean it's this black box type of thing?" Now everybody they kind of understand what AI is to an extent. Nobody really knows how to, I don't think, really apply it to the actual world, except for people that know what AI is. So like you still have a lot of growth, but it's changing unbelievably quickly. And I think it'll continue to change. I think the biggest thing that you're kind of saying is get in front of the momentum. Find a way to get in front of momentum. valuation, the actual number, nobody cares. But if you're able to understand that bottoming process, get in front of that bottoming process, you'll always be able to get in front of it because there'll always be an opportunity somewhere.
Yeah, and that's, I mean, and honestly, that's partly what I mean, as you've worked on the macro side, that's what the whole concept of like the quads and the signals are really derived to
Yeah.
do, right? It's to sort of tell you, sniff out when these things might be changing for better or for worse, and then giving you a backdrop to put that in to like better understand, like, what is it telling me, right? If
Yeah.
so, like, let's say like right now, right? If something's a cyclical company that's signaling, and knowing that the forecast is that we're moving into this kind of growth accelerating, inflation accelerating, you're like, oh, well, that I get it. That's just like, oh, this is cyclical recovery, and it probably means earnings revisions for these cyclical companies.
Yeah.
Yeah.
I mean, absolutely. Yeah. I mean, I almost think of it even broader now, like in terms of like, yeah, you have cyclical companies, but also like, what is a cyclical company? I mean, there's AI, right? Once people start understanding that, hey, there's AI models that can do clustering for you, and they'll identify, you don't have to go out and manually identify all these companies that are the same. Give it to an AI model, it'll tell you exactly what it is within a couple of seconds.
Yeah,
Right?
no, we did a little bit of that actually when we were looking for companies. I remember we had done like it was more machine learning because it was a couple of years ago, so it wasn't really the large language models weren't around yet. But what we did was like searching on like finding peers through like language that was in multiple filings, or like looking for stuff that like was near enough that like that it might suggest probabilistically this company might also have something like be similar to that. And so when we were trying to map sectors out and find ways to play certain things, you'd be just sort of like using these things to sort of try to track down what companies might not be readily obvious to people, but might be plays on these on a trend or something happening.
Yeah. I mean, and that was, I would, those were probably, some machine learning. Oof, and now it's become deep reinforcement learning from there. And so you're just going to get, it'll be fun.
Well, I mean, yeah, I'm excited to like kind of like, I actually liked embracing this type of stuff. Like I did some things like, as I said, like this is all pre-LLM. So, but like 10 years ago, I was doing this thing of like, I tried to note, like for years when I was listening to conference calls, I talked about like the change element language. Like I was listening for certain things that I might be saying. So I would take those down. And then when searchable transcripts became a thing, I was like, well, I should just search for these phrases, like these common phrases that indicate the pricing might be going up, or they're taking capital out of a business, or that margins are improving, or margins are getting worse, or you could like, there's all this language you could just kind of like search for, and it would sort of highlight, these things would come up, and we even built this thing where we were doing like scoring them based on how many references to certain categories, and like trying to then like bubble up, hey, this could be a margin improvement story. You should go look at it, right? Because I think one of the things about the industry, and you've been around long enough to know it, like you've been doing this too, like there's a lot of like very simplistic thinking sometimes that people are like put in the front end of the machine, like, and you just like they're searching, like I can do an equity search in Bloomberg, and yeah, sometimes it's like I feel like I'm sifting for gold in like the stream, right? So it's like, oh, I got one. Like, it's like you're like, yeah, we can all search for like cheap stocks. We can all search for stocks where insiders are buying. Like that's all very easy to find. And I'm not saying that there aren't some good ideas that can be found that way. It's just like it's just a very obvious. So like if every investor's like, oh, well, I look for the intersection of, growth and momentum and quality. And you're like, right, that's kind of what everyone's doing. So they're all screening the same names. Like if you're not doing a novel thing up front, how are you even know that you're bubbling up things that are worth spending time on?
Yeah. Well, it's almost a mindset, right? Like in order to understand, you're using your old mindset for this newer technology. For the newer technology, you have to use a new mindset, and really because right, you were identifying the phrases, right? The newer way is, why are you identifying the phrases?
Yeah,
Let
no,
the computer tell
I wouldn't
you.
even want to have to do that. I would want to let it do that, right? Because that's going to be much better at categorizing that and
Yeah,
cataloging it than I'm going to be, right? And it doesn't even
yeah,
need to catalog it. It just, once it's learned it, it'll just look for that language. I mean, I like that kind of
exactly.
stuff. Like, I think you and I talked about this offline. Like, this is the type of stuff I think is going to be fun because this will be like really cool ways to do searching for companies. Like, the new searches aren't like, give me all the stocks under $1 billion that trade at 10 times earnings. I mean, like, okay, I mean, I guess that's a list, but like
Yeah,
the the real ones would be like trying these novel ways to get stuff onto your backlog that are like that you want to maybe own or maybe trade that are
yeah,
like got there from a novel way,
yeah. And do you think AI is commoditizing any certain edges?
I mean, I think it's going to speed a lot of that stuff up for sure. But like, yeah, that's a good question. I think of it this way, right? Like every time this new like news is, and this kind of fits with like the Mandelbrot stuff that Keith talks about a lot, right? But like because the traditional way of thinking about it, the traditional risk models in finance tend to think of everything as like continuous and just having like normal variability, right?
Mm-hmm.
Like normally distributed variability, and that's not the reality. Like we know that's not the reality because we've had you know 7 sigma events that have happened like multiple times within decades. So you're like, well, that can't possibly be the case if these things are all continuous. And any of us have watched like stocks go gap up or gap down, then there's like discrete information that's happening that's impacting that. So they don't move continuously. They move continuously sometimes and they move discretely at other times. And like that happens because there's new information or something that kind of like almost like throwing a stone in the pool, right? Like it's like the efficient market theory would almost be like, all right, we get this continuous like movement when the pool is still because like most of the important information is kind of disseminated, right? Like, and then there's like new information added. That's like throwing a rock into the pool. And like, and how long is it going to take to reach an equilibrium again? And so that the time to reach new equilibrium is going to only speed up. Like new information will get digested and then like the machine will chew right through it very quickly. And every time we do this type of like stuff that's about you know screening, quantitative work, just high frequency trading, all this stuff is kind of designed right for that to like just speed this up and get it faster than the next investor can.
Yeah. That's really cool. Yeah, yeah. It's almost like the ripple, and the end of the ripple becomes quicker and quicker almost, which almost makes you think we'll have bigger waves. I have a couple of. I'll only have a couple more questions here because I don't want to take too much of the time of your time. We probably have a lot of young investors watching this. They all probably want to, not all of them, but they may or may not want to become portfolio managers, or maybe that's their goal. So I would ask, what skills should a young investor build to stay relevant to become a portfolio manager in an AI-driven world?
Yeah. Boy, it's going to sound really cliche. I mean, just read a lot, right? Like, I mean, read a lot of things in a lot of different areas. Just so the more you can, like, we have a lot of tools that we can use, like, to help with this stuff. But like, you want to have models in your own head about how stuff works, so you can like you'll get a sense of like what's changing or what's happening, like what might be interesting. Like, and they can't be all the same stuff, right? You need to feed yourself like some heterodox thinking, so you have some like maybe slightly askew ways of looking at some things than other people do. Because that's how you sort of uncover novel concepts or novel ideas or novel opportunities. I mean, that's certainly one. Um, be willing to skin your knees. Like if you want to learn about investments, you got to just kind of like, it's like riding a bike a little bit, right? You just got to get on and do it. And you'll fall off a bunch of times and be like, well, that was dumb. And I lost a little bit of money. But like, it's kind of, you just have to do it. Like nobody becomes like a good investor without having actually had some horrific like investment loss stories, like where they're like, oh, I learned a big lesson that time.
I call it limit testing.
I like that.
You gotta go out and limit test.
Yeah,
It's a nice way of saying you gotta
right
lose
up to
some
the
money.
edge without breaking it. Yeah.
No, but you really, well, you gotta feel the pain is really, because once you feel that pain, you'll learn some good risk management strategies along the way with that.
Yeah, right. Totally, totally.
And then I'll wrap up with this question: is what do you know now that you wish you knew when you were younger?
Oh, that's I mean, it took me a long time to put all the pieces together, right? It's like how to look at like how to even look at a company. What are you even trying to find out? What's important to even know, like how to model it, what that, and then learning more about portfolio management, putting how do you put a group of companies together, right, to create a new entity, which is the portfolio that has its own trading characteristics, that are a sum of and then some of like the underlying components of it. And then I think, I did my CMT, but I think I wish I was doing even a lot more of the risk management stuff we do now earlier in my career. I mean, it would have made a huge difference to me if I had had some of these tools then, you
Yeah.
know.
So you like to get a little too concentrated?
Yeah, I mean, I actually do. I mean, I always do actually like
Yeah.
that. I mean, we were framing this like discussion around like sort of evolution of active management. I'll tell you something. I mean, active management partly gets a bad rap because they did it to themselves. Like the whole point of active is to take active risk. So if you don't actually take much tracking risk, you can't really outperform a benchmark. And you certainly can't outperform a benchmark after your fees. And it's only going to take a few years before people are like, well, what am I paying for? If you can't outperform with the fees,
Yeah.
then I'm not really paying for anything here. And so when the industry grew a lot through like the 80s and 90s, even before I got into it, right? There just became, I think, like a real culture of like being a like fee collection business, not like an outperformance business. And so like, yeah, I think as time went on, it's just like it's moving back toward what active management needs to be, which is that like, no, you're paying us to take risk
Yeah.
because we're not trying to minimize tracking risk. That's our alpha. We want to take more tracking risk and then manage that risk carefully so we can deliver information value that gives you like an uncorrelated outperformance, right?
Yeah.
Right.
Yeah, because if you're paying for an edge, use your edge.
Yeah, and I think like I've never actually tried to do this math, but I'm sure we could. It's to basically like people say, oh, passive is the best way to go because it's low fees and you just a market scope over time, so just put it in passive. And so like it's all we talked about all this money that's moved from active to passive. It's like, oh, why do we even bother paying for a manager? But I actually know that if you had, let's say like five, let's pick like you had five managers who all took like, decent sizes of active risk and then were uncorrelated to each other and you put them together in a portfolio and paid a fee, you'd be much better off than having just put money in passive.
Yeah.
So, because sort of move out the efficient frontier. So I think I think the industry kind of did it to its own. They didn't want to actually take risk. And so, can't really outperform if you don't take any risk. Can't outperform the benchmark if you look just like the benchmark. I think we all know that, right?
No, that reminds me actually of one of my first jobs like in the industry was I was just doing modeling some company. Learned a lot from these guys, and he was like, go model this company. It was some like a for-profit college. So I go out, model it, I hand it to him, and he's like, why doesn't it look like exactly what I gave you in terms, it was another analyst report. He just wanted me to mock the analyst report. I was like, well, what do you mean, why doesn't it look like that?
Did you read that one? I don't think I rewrite it for you.
It's right here. But it's a great industry. And obviously, anything else you'd like to wrap up with? Where can people find you?
Yeah, I mean, I don't have as cool a moniker as you, the Hedgeye, but you can find me on Twitter at rpkent. And yeah, I mean, I'll try to drop stuff in there occasionally. You can certainly look us up on the Hedgeye Asset Management website and see what we're doing. And yeah, occasionally these types of things. I'm going to drag you on. We're going to do this reverse. You're going to come on the other Hedgeye Asset Management podcast we're doing.
What is it called?
Protect the Pile.
Protect the Pile. I can't
Yeah.
wait for that. Thank you, everybody, for joining us today. I'm Ryan, and this is RPK. You can get him on the Twitters, Hedgeye Asset Management. I'm Hedgeye AI on the Twitters. And just in case everybody missed it, we actually have an intro, and so that will be our new outro for this episode. We'll be back in 2 weeks. Thank you, everybody, for joining us.